Hello class, this is Brian from financialtrainingschool.com and welcome to GT213 Leverage. So just a note before we start, I won't bother to go into the details for the different account types. That lesson will be made in the next year if and when I make the stock series, since it's more prominent there. So leverage in the world of trading is similar to mortgages in the housing market. You go to the bank to get a mortgage to buy a house. So you put down some money as down payment for collateral. Same thing happens in trading. You open a margin account with a broker, which allows you to leverage your money to trade more. Leverage is one of the many things a margin account can do, and again, I will cover this in the future video. Depending on what instrument you're trading, you'll be given different leverage ratios. So in stocks, you're usually given a small leverage ratio, something like 2 to 1 or 3 to 1. In futures, slightly bigger, something like 10 to 1 or 15 to 1. In Forex, this is the game changer, and this can be quite large. Prior to US regulations, Forex leverage could go up to 400 to 1. But nowadays, after US regulations, all US regulated Forex brokers can only provide up to 50 to 1. But some international Forex brokers still provide between 100 to 400 to 1. And more recently, a few brokers have started offering 1000 to 1 leverage. Leverage, however, is a double-edged sword, and it's one of the causes of the 2008 housing crisis. Think about it. I just mentioned on the previous slide that leverage is similar to mortgages. If you're on the right side of leverage, it can be quite profitable. But if caught on the wrong side, it can be deadly. So here's how it works. Since this lesson is primarily for the Forex series, let's use Forex leverage as an example. And since the majority of my viewers reside in the US, let's say the leverage is 50 to 1. A leverage ratio of 50 to 1 means you can trade $50 worth of currency for every $1 that you have. So in Forex, a standard lot of currency, which will be elaborated further in Forex 101, the first video of the Forex series, is $100,000. So with 50 to 1 leverage, you would only need $2,000 to trade a standard lot. So here's a numerical example of the potential gains and losses that you can sustain. So for gains, let's say you buy one standard lot of Euro USD and it goes up by 1%, meaning the initial $100,000 standard lot went up to $101,000 for a total profit of $1,000. But here's a kicker. You only needed $2,000 to buy the $100,000 standard lot. So the effective rate of profit is actually 50% gained, not 1%, since you made $1,000 with $2,000 only. But on the flip side, for losses, same example, but instead the value of the standard lot drops by 1%. So instead of making 50% profit, you're now sustaining a 50% loss. So this brings us to the next topic. Depending on how much you lose, your account might trigger a margin call. A margin call is triggered if an account is below the margin threshold required to stay in good standing. Every broker has their own margin call threshold based on their risk level or your risk assessment, etc. So let's say, for example's sake, the threshold is 50% of your margin level. So in the previous example, you needed $2,000 to trade a standard lot. The threshold would be $1,000, since this is 50% of $2,000. So after the losses sustained in the previous example, your account would be subjected to a margin call. Once again, the margin call procedure differs between each broker. Sometimes they give you time to close the position yourself, or to prevent further losses, they just initiate the margin call immediately and close your position. Sometimes this can work in your favor to prevent further losses, but sometimes after the broker closes your position might bounce back on its own and you would have been okay, but they already closed you out, so you just lost 50%. So it depends on the market situation and the broker, etc. Some final notes before we end off. Leverage, e.g. debt, is good if you know how to use it. If not, stick to trading 1-to-1, meaning you don't borrow. You simply trade using cash, no leverage involved. Most people who use leverage for the first time are naive and are usually clouded by greed. You'll lose money just as fast as you make it, so just keep that in mind. So if you're new to leverage, I suggest you start small and then work your way up as you gain more experience trading with leverage. So that's it for this lesson. I just want to make a quick video on leverage since we'll be using this concept when we trade Forex in the Forex series. So hope you guys enjoyed this video and I will see you guys next time.